because you're working on improving yourself, and most people do like to improve themselves anyway. Even if you've got a pretty decent credit score and pretty decent stuff going on, there's no reason why you shouldn't continue to improve your situation. As you pay stuff down, you make your payments on time, your situation should improve. But let's say for whatever reason, let's say you have an 8% rate for 30 years, and you don't want to refinance down the road, start your term over, or I mean, there's different reasons why you may not. Well, there's a few ways that you can pay this off, just like you borrowed money at a lesser percent. And one of the things we used to do for people is we would get and I encourage you to do this, get a copy of your amortization schedule. What that is, that's the whole term of your loan, and it shows your principal and interest, okay? And that breaks that down completely. That's not your insurance and taxes. That's another whole story, which we'll talk about a little bit more in a few minutes here. But your principal and interest, it's going to show, and just for example, if you have a 30-year loan, let's say you're paying $950 for the first month in interest and $50 in principal. And it may or may not be that much, but it is something significant, the difference. At the end of the term, as you make your payments, they change a little bit each month. And at the end of the term, it will be exactly the opposite. So at the end of the 30th payment, or the 360th payment, which is the 30th year, then you're getting to maybe 50% interest, and 950 is going towards the principal. Okay, because the principal is what you're going to want to pay down as you go along. A typical loan, if it's a fixed rate at the 15-year point or half-year point, depending on where you're at, will be it should be exactly 50-50, 50% interest, 50% principal. Okay, well, there's a lot of different ways you can do this. One of the things that, in fact, what I did with my very first conventional loan I had is I got my schedule, and I took the interest from the very last payment and applied it to the first payment. By doing that, and it was like $15 or $50 or something. I don't remember the exact amount, but it wasn't that much. Well, I could afford to do that. Every month it goes up a few dollars. And if you do that exact formula right there, you will pay your 30-year loan off in 15 years. Okay, what that is like doing, though, that is because of the compounded interest rate. What that is actually doing is like borrowing money at 4% instead of the 8%, because you're paying it off in exactly half the time without the obligation. So let's say that you're doing that for a while. Let's say your situation changed, and let's say you're 5 years into it, and maybe it's an extra $250 or $300 a month interest that you were adding to that. If you have a bad month, you don't have to do that. You're not locked in. You're only locked into what your actual payment is.